2026 is almost here, and here's the cold truth. If you're still out there wholesaling deals and wholesaling houses or raising individual private capital for each of your deals one at a time, then you're just getting lapped. Funds are where the game is heading, period. In this video, I'm breaking down how to launch a real estate fund in 2026 using our design, build, raise, launch fund founders formula. Now, what's up, guys? I'm Devin Robinson, and I help operators, fund managers, and entrepreneurs launch funds, raise smart capital, and scale without chasing money like a bad network marketer. And today, we're breaking down the playbook for real estate funds in 2026. And I'm going to show you guys the different types of funds, which are fix and flip, debt funds, multifamily funds. Those are the most popular ones, and how they all fit into the same framework. Right, as you can see here, we've got our design, build, and raise and launch formula right here. And most people skip this step right here. And we're going to dive into the design section. And most people skip this step, but it's a big mistake because design is where you decide the why and the what. Let's look at a few fund types here. So we're going to look at fix and flip funds first. So let's say you have a fix and flip fund, and it's designed for like a short duration. You want high velocity capital. And instead of doing the one-off deals where you raise money from Uncle Bob every time you find a property, you want to pull investor capital into a fund. This actually was my first fund. And then you want to recycle that money across multiple flips. And here's what happens from the investor perspective. This is going to be pretty quick. This is going to be anywhere between like 6 months, right? So like they're going to keep getting their distributions every 6 months, or you can even move it to, once you start doing consistently, monthly or quarterly distributions, right? So we're building this out right here. This is how they're going to get paid. We'll talk about that a little bit later. But investors like this strategy because they want quick capital rotation. Money in, project done, money come back and back into another project. It's predictable, short-term yield. You could do anything like this because in your design stage, we're designing, hey, what's the thesis of the fund here? The thesis of the fund in the design stage for this is going to be fix and flip. And if you are going to do anything like multifamily or, debt, that's where you would design what the fund is about here. We're going to talk about what the fund is about, what our thesis is, who's on our team, who's raising that capital with us, and then what our mission statement is. So we want to walk through all of those things in the design phase. That's kind of the most important phase here where we're talking about that. We're talking about how quickly is that money going to rotate? What's the thesis of this? Something tangible, something you can see the house, you can show the work so they know exactly where it is. Are they in certain areas? Is this going to be in the US, in the, North Carolina and South Carolina in the US? That's how mine was. The sales pitch is basically your money doesn't just sit around. It's flipping as fast as we can turn deals. That's what works here on fix and flips particularly. And how many times a year can you flip the same dollar in a year? For example, if you raise 1 million, right, and you do 3 flips a year, which is not a lot, at a 10% margin. So there you go right there. That's a 300K return potential on their money. The faster you move, the higher the yield is for the LPs. So you have a ton of opportunity to be able to turn more if you could do more than 3 a year with those flips. And so you can leverage things like hard money loans to be able to do this. If your project is $400,000, but you got to remember, if your project is $400,000, right? If your project costs you $400,000 to do, which would be kind of crazy because you're probably paying for it all cash and not using a loan. But let's say you do that and then it sells for 350, then you just got blasted. Right? That doesn't work out well. You need to underwrite conservatively. This is no HGTV math here. This is no HGTV math here. So another risk with this is having deal consistency, right? The fund is only as good as its pipeline. You want to have enough deals, and this is where probably the operator coming in here and finding these deals is so important. On a fix and flip fund like this, the operator is very, very important. The fund is only as good as the pipeline. If you can't source deals consistently, capital sits like on the sidelines and LP wonder why the fast money isn't moving. And these are the risks that you run into. The housing market is slow. Flips take longer to sell. This literally happened to me in my first fund and it was a disaster. I'm not even going to sugarcoat it, but you have to communicate well. Execution of this risk, you have to things can happen where contractors disappear, materials run late, costs blow up. You run into investors who may want out because of the project is taking too long. These are things that happen, especially if you're using individual investors, but why it's better to have a fund because you control the money. Smart managers bank on reserves, multiple exit strategies, and even transparency on the timelines. Investors don't care that you picked out trendy backsplash tiles. They care that their $100,000 is back in play by summer, or the next couple of months, not sitting like it's grounded, um, like a kid with bad grades. Another type of fund is going to be a debt fund, right? So here we're working with debt funds, right? This focuses a little bit more on yield and staying focused, right? So consistently monthly income that's 8 to 10%. When you build a debt fund, you're basically becoming the bank. You're not swinging hammers, you're not managing tenants, you're lending money secured by the real estate and collecting interest. Investors really love to see this because they don't want the volatility. They want to know, how much am I getting paid? How often am I getting paid? How safe is my principal that's in here getting paid? And a lot of times, this is where you're going to be able to do things like give out those monthly dividends, because you have the ability to do that because of the fact that this has monthly income coming in. That's why debt funds are all about yield and safety. Most debt funds will offer investors 8 to 10% annualized returns, often paid monthly, and it feels like mailbox money. They love that. Now, key metrics here are going to be LTV, right? You want to lend at LTV, which means if the property is worth 1 million, you want to lend 700K. So your LTV is 70%. The lower the LTV, the safer for you and your investors, because even if the borrower defaults, you can foreclose and sell the property with equity cushion left. This is important. Debt fund managers brag about, hey, we never lend above 65% LTV, because that screams safety to their investors. Now, what happens if a borrower stops paying, though? Do you foreclose? Do you have reserves? Are you in a first lien position, which is the senior debt, or are you in second lien position, which is junior? Investors want to know their money is backed by real collateral and not just trust. The beauty of a debt fund is you're not chasing appreciation. You don't care if the property goes from a million to 1.1 million. You're just collecting your 10% like the bank. And guess what? The bank always gets paid. Third one here is a multifamily fund. Multifamily funds are designed for people who want long-term wealth, not like a sexy quick flips, but stability, tax benefits, and growth. Investor perspective, that like and growth. They care about cap rates. What's the property worth in correlation to income? So they care about cap rates. They care about cash on cash returns, which is how much cash flow are they actually pocketing. And then they care about IRR, which is a blended return over the life of their investment, factoring the time that they're in it. This is where you talk Wall Street language, because multifamily attracts institutional style capital. Now, let's walk through cap rates for a second, because this is important. Cap rate equals net operating income. Okay, net operating income divided by property value, right? Divided by the value of the property. So if a building generates 100K in net operating income, and then we're going to go ahead and it sells for 2 million, then there's a 5 cap right there, right? That's important. The lower cap rates mean they're more expensive. Most likely that's going to happen in more expensive markets like New York and LA. Higher cap rates equals riskier or less competitive markets. Now, if we're looking at cash on cash reserves, right? See, like COC, then if an investor puts in 100K and the annual distributions are 8K, then they're at an 8%, then they're at an 8% cash on cash return. Something tangible. Investors love that metric because it's literally how much money hits my account each year. Now, if we're looking at IRR over here, this is measured total return over time, including cash flow, sale proceeds. So, for example, let's say that there's 7% annual cash flow, right? There's 7% cash flow and a 30% gain because of appreciation, forced appreciation when the property sells. This is a blended IRR of maybe 15 to 18%, depending on how long the hold period. IRR matters when you're pitching to sophisticated investors or institutions. There's a thing called exit cap compression. And honestly, this is just fund manager lingo for when we sell the property in 5 years, will the market value it at a higher or lower multiple? So we buy at a 6 cap and it sells at a 5 cap, that's cap rate compression. Your property just skyrocketed in value because buyers are willing to pay more for the same income stream. If caps expand, go from 5 to 6%, then your property lost value even if income stayed flat. Now, there's translation for this because that's a lot. If cap rates go down, you look like a genius. If they go up, you suddenly didn't predict the market right. Investors will nod when you say exit cap compression, but what they're really asking is, when you sell this thing, will I make money or not? So for a side by side comparison, you have fix and flips, right? So fix and flips equal velocity. You're flipping houses with investor capital. It's all about speed. How many times can you turn the same dollar in a year? Short holds, high activity. Investors like it because they can see quick movement and tangible projects. Debt funds equal income. Now, you're the bank, you're lending money, returns are fixed, boring, predictable. Investors love the safety and collateral of steady monthly checks. Multifamily equals wealth later. And a little bit more wealth preservation. You're an owner, you're banking on long term appreciation, tax benefits, and big paydays at the sale or a refinance. It's less about quick cash, it's more about building wealth over time with leverage and cap rates. So that's how we compare those three types of real estate funds. Now, your job in the design section is to align the fund type with the investor profile. Pitching a 5-year multifamily play to a guy who wants to make his money back in 9 months and get those distributions, that's like trying to sell kale chips at a barbecue. It's the wrong fit. Now, let's go through build for a second. Now we get to the infrastructure of it, right? So how are we going to do this? Where you turn the idea into something that looks professional. Here's where we go into this phase. The GPLP structure is going to be one that we really dive into here, and this is going to work well for us. This is going to work really, really well because they have really no say on how you flip it, what you do with it, how you end up using the money, but they know that they're going to benefit from it. Fund documents, of course, and then you have the compliance of it. Is it going to be a 506B or a 506C? Is it going to be a private or public offering? And then you want to talk through your fund admin and your banking and how you're going to do your distributions. And here's how it shifts by fund type. Fix and flips, your docs better spell out that it is a short-term hold, fast recycling of capital, and how investors get paid between exits. Very, very important. On fix and flips, your docs better spell out short-term holds, fast recycling of capital, and how investors get paid between exits. If you're running a debt fund, your doc should read like a fortress, right? Strong lender rights, clear collateral, protection of if someone defaults. Multifamily, this is all about waterfalls, pref returns, catch-ups, profit splits. These make sure that your terms are clean and fair. Now, don't let your cousin who just passed the bar draft your docs. Hire a real fund attorney. This is where you can reach out to us at Fund Founders. We will do your documents for you. We will help you to launch and scale your investment fund. This isn't the time for shortcuts. Now, let's dive into the raise of everything. This is where most people either shine or flop. In fix and flips, what we're pitching here is we've got deal flow. We move fast. Your capital is working every month. We're selling velocity. Debt funds, you're pitching, we're the bank. You get paid before anyone else. Consistent monthly checks backed by collateral. You're selling safety here. Multifamily, we buy big, stable assets. You get long-term wealth, growth, passive income, and tax benefits. You're selling security and upsides. But here's the kicker. You don't need 100 investors. You need 3 to 5 who actually believe in you and write meaningful checks. And stop trying to convince people to educate them. If someone doesn't get it, you move on, and that's okay. Now we're going to talk about the launch phase, right? This is where we're launching the fund. Launch is not posting on Instagram and praying. Here's how to do it right. You lock in anchor investors before you go public with this documents. You can get soft commitments. You announce with clarity. We're targeting X asset. We're targeting X asset with Y returns under Z structure. Start deploying capital immediately once you get these docs lined up. Keep your reporting transparent from day one. And the biggest mistake is waiting until docs are finished to start raising. Raise and launch are not separate. They overlap. So you can totally start raising capital for this. You just can't take in any capital. You can get soft commits. And then once you do that, then we can start filing your forms for you and making sure you do that. So there it is. Design, build, raise, launch. In this series, I'm going to dive deeper into each type of fund. We're going to talk about private equity funds and VC funds, but here are real estate funds. And because in 2026, the people who master this will own the deal flow. And if you're ready to structure your own fund the right way with systems and compliance built in, check out wearefundfounders.com/apply or click the links in the bio. We'd love to help you to get there. All right. And as I always like to say, to great success and greater impact. Peace.